Welcome back once again. Happy New Year if you missed us on the last one. And I do apologize for everybody else who has registered at our past events. I know we've been hopping around two different platforms. We're back to our original one. I know some of you didn't get the link, but that's okay. We have your email. We'll make sure you get a copy of the recording and it'll be available to you. So we sincerely apologize. But going forward, we're back to our original platform where we started. As they say, sometimes when you get proposed with new shiny light, the shiny light doesn't look as good once you get in. And we ended up discovering that. So goes without saying, we're excited today, once again, to have another great discussion about blockchain and tokenization, and then obviously the private capital markets. But before we get started, I want to thank, obviously, our sponsors, Nuvei, who have been very supportive of the KoreSummit series that we have. They're a global payment processor in over 180 countries around the world. They're also NASDAQ publicly traded. So thank you to Nuvei. And of course, KoreChain, one of the first blockchain companies that has gone through the process of being SEC qualified for their blockchain technology for digital securities, NFTs, and security tokens. All right. So today we are, Kiran and I, Dr. Kiran Garimella and I are going to have an interesting discussion regarding three hot topics. Tokenization, it's a big, so we're going to unravel that. The private capital markets, and why is there so much confusion around this? And I think that's the part that we're really going to harness on today. Hopefully we won't get strayed off too much from our discussion, but the idea today is really to make sure that we have a really good understanding what each of these elements are. So, and this is an important part. I'm going to break it down because I'm one of those individuals that likes breaking things down into buckets. So tokenization is a technology. So that's tech. Private capital markets is a regulated environment. And then we're going to talk about the confusion. So it's amazing when you break it down into those three, how hopefully maybe the confusion isn't so confusing. But all right, so let's get started. So Kiran, let's just get started. I mean, before we talked about blockchain, a little bit what it is, but let's talk about what is tokenization. Give us the basic and the, obviously what everybody else is reading, because it's the big buzz. So let's hear it.
Yeah, I know that is one of the most confusing concepts. It sort of sounds very simple, but it can be confusing once you get into the details of what tokenization, what are tokens, right? There are so many different types of tokens, and people ask, why do we need tokens anyway? We have something called shares and securities in companies, right? And to kind of give a context to this one, if you look at a traditional company and it wants to raise capital, it creates what is called shares, equity, or perhaps bonds, but just let's stick with equities like shares. And it sells these shares to investors, whether in an IPO, a public market, or a private market, doesn't matter. Shares are shares, right? And in the past, there used to be paper copies of the shares and paper certificates and so on. But nowadays, we create electronic records. So what's different about electronic records and shares versus tokens? So every share in a company stands for the whole company, and then you kind of break it into units. So there is a fractional ownership for every share within all of the company. Tokens are somewhat different. They offer much more flexibility. So you can actually create tokens to stand for certain asset classes within a company. So a company may have goodwill, it may have inventory, it may have real estate, it may have so many different things. But when you buy shares, the traditional shares in a company, you're basically buying all of that in some sort of a package. And you have to read through the financial statements to figure out, how much of the desk chair in the company do you own and how much of real estate do you own and things like that. But in tokens, you can say, look, I will take all the real estate in my company and bucketize that and create an asset token out of that one. And let's deal with that separately versus the goodwill or something else, or maybe in a different geography. So you can create all these really interesting things. But the other important point, Oscar, I think it's all opened up, is it allows people who are not in traditional finance and don't have the traditional financial machinery to benefit from using tokens. So tokens in one way are simply securitized assets of a certain class, but they offer a lot of flexibility and functionality.
Agreed, but we've also seen where it's not just being used. So I just want to make sure for the audience they understand that tokenization. Obviously, this topic is regarding the private capital markets, but in general, tokenization is being used in other contexts, right? People have been hearing tokenization of art and music and other things. It's not just physical art; it could be digital components as well. It's a representation of something else, and I think where the line gets crossed in tokenization, and we're going to cross that. Hopefully, if maybe we'll bring it up some more, but I just want to make sure the audience has a really good grasp of what tokenization is, because I always feel that people often speak of tokenization in such a way that everybody knows, and we know that what it is. It's actually sitting it's going to be sitting on top of blockchain itself is going to create this token. So tokenization, this token can be fractionalized, it can represent a real asset, it can do a whole bunch of different things, and it can also be connected to a smart contract, and it can have a whole bunch of different rules. And the whole thesis behind tokenization in the market, just for everybody else, is, and you see it, it's supposed to be transparent and it's supposed to be lower cost. So I want to make sure we cover one thing about, let's talk about transparency. So it is transparent. You have to be very technical in nature in order to get to that. And as you know, if anybody's ever been robbed before, your wallet, or you've been scammed, getting that, this is the IRS, send us $500 and so on, you all know that people disappear very quickly. So I want to make sure we're all clear that as much as we've been it has these attributes, there are, like any other software program, workarounds that not everyone in the industry, but those that know how to manipulate this can. So we have to be very careful with that. Lower cost, well, that's debatable, and again, that depends on the type of blockchain you use. So it's really important that not everything gets classed into one thing and says, yeah, this blockchain, it represents all of that, and we're ready to go. Each one has its pros and cons for tokenization, and it's important people classify that. And so here is the part where I come in, where's the bridge where we go tokenization, private capital markets. Really simple. It's really simple. Is the expectation from you, the individual, when you buy the token or you invest in the token, whatever term you want to use, is the expectation for you to have a return on that? And a return is, I bought it for $1, I hope to make $5. I bought it for $1, I'm going to sell it for this, because it becomes an investment. And two, there's an expectation from your end, that it's going to gain in value. And there's a reason I'm making this really important reference point, because in the early days of when tokenization first came out, in the early days, the argument was, Oscar, come on, tokenization is just like air miles. And I go, no, it's not. Yes, it is, Oscar. Look, I can earn a point. Why not call it a token and see it, and it has a representation? So this is the difference between air miles you get from your airline, your hotel, your store, wherever. Today, we're all getting bombarded with points. And why isn't the SEC going after them? Because when they give you those points, there's one thing they do not do. They do not tell you the par value of that one particular point. What they tell you is the following. They say, if you have 7,500 points, I'm going to give you can get a book, a chair, a glove, or a t-shirt. You pick. Each one of them to you has a different value. To some people say, hey, that shirt's worth 100. And then over there, that air ticket is worth 400. It doesn't, whatever value, but they're not telling you what the value is. You're picking and choosing. And tokenization is different. Tokenization is actually putting a par value on that particular token And
Yep.
not only that, it can fractionalize it, and it has a value of representation that regardless of what you're buying, that it's worth 100. I got to have 100 of these in order to buy it because it's one token in order to get it there. And I think this is where we now move over to the private markets, right? Tokenization and the private market. So let's talk a little bit about that. You started talking about it, shares. So why is this so important? Where is the benefit of tokenization and the private market? We know what people are seeing, but where's the true value in tokenization?
I mean, there are several, right? One of the most important things is that just that very simple concept of tokenizing something opens up the flexibility and the ability of companies to create tokens for various things in different forms. So that's number one. Second, it offers a level of transparency that was not there before. The third piece is that this is, of course, backed by blockchain. It is very dependent on blockchain technology. So all of the transactions become very immutable. So they are there on the blockchain. They're widely decentralized in many cases, or at least widely distributed in many cases. And of course, now there are secondary trading platforms on which you can actually trade. You don't have to go the route of the NASDAQ, the NYSE. That's an entirely different ballgame. Now you have entirely different ways of doing this, right? So I mean, there are a lot of these benefits that you typically will not see in the regular share markets. And of course, the other big part is the fractionalization. I mean, you can own a very, very small piece of Mona Lisa, if they tokenize something like that, which, most Main Street America cannot own something like that. They cannot make those investments. So we're seeing a sea change in the number of people who can now participate in markets. And so we have to leave the public markets around and just look at the private markets. I mean, this is all private markets, right? So that's kind of where I see a lot of these benefits, Oscar.
Okay, well, I mean, that's interesting. You're seeing it from the front end. I personally have seen, I know people use the word tokenization. I'm going to come back to blockchain. I mean, anyone who spent any amount of time in whether the public or capital, and you've had an insight into how it operates, you clearly start seeing the inefficiencies. Look, everybody who's listening in today, you experience inefficiencies all the time. Number one place you go to is when you want to get your passport renewed, or you want to get your driver's license renewed. You're standing in line there and you're going, come on, with all the technology. I mean, who hasn't done that, right? Who hasn't actually sat there? So that's common sense. So the more vertical the business becomes, you only see the surface. But the real value in tokenization, blockchain, and the private markets is understanding what it takes to take a transaction from A to Z. And so and this is where the confusion starts coming out, is how do you get a transaction from A to Z? So first you need to map it out in the traditional sense to make sure that you've covered it all. And then only then can you then apply that to the tokenization and see the true benefits. And the benefits are definitely there. There is no doubt in my mind that using blockchain and tokenization in the private capital markets is a transformative event in how the private markets will evolve. Case in point, I mean, we can't attribute this yet to the private to blockchain, but it's going to come. We're seeing more visibility of private companies than ever before. I mean, 10, 15 years ago, it was only a very small number. We saw now the numbers are growing and growing, and it's only going to get better. So no different than the public markets has the visibility, the private markets can do the same, but we have to do it in a very different way. We cannot rely on the infrastructure of the public markets. The public markets infrastructure has a limitation. If anybody has ever noticed, at no given time in the last 30 years, there has been more than 100,000 publicly traded companies.
Exactly.
People go, there's IPOs going all the time. For every 10 that go up, 10 go down.
Exactly.
And numbers have never changed.
And here's another part too, right? The account. So you said the transparency for in the private markets that's growing up. The scrutiny is going up, but it's also the accountability. people are being held accountable. So in the past, the private markets were deemed to be like totally private. They can do whatever they want. That whole narrative is disappearing now. You're actually seeing a lot more holding the feet to the fire accountability from the SEC, the FINRA, the FinCEN, so many other of these organizations. And I think that's been a big change as well.
Correct. It's
So,
the
yeah. No, please.
No, I was just going to add, look, it's, I mean, we're, as I said, the question is, what are the benefits to the private markets? It's from the front end, it's providing the transparency. It can, I just want to be very clear. I'm using the word can because there is a fundamental element that we need to deal with is that, you know, not all blockchain technologies are the same. So people need to be wary of that. Don't use it as a generic word. So number one, tokenization is great. You can do a whole bunch of different things. The second one is there a benefit to private markets, for putting different assets at, real estate or
Yeah.
venture, and is there a benefit to the investor? All of these things are great. But again, there's another question that needs to be asked at the very end, and that's to say, okay, depending on what blockchain technology you use, because this is going to be important. So the benefits are great from an investor perspective. I have an immutable ownership. I like that. It could potentially offer a faster liquidity. And I need to be, this is an important word here. It could potentially, because look, after all these years, it's been 4 or 5 years, people are still trying to figure it out. It's still not all there. Why? Because when you take the traditional path and you understand all the different pieces regulators want you to follow. Now you're hearing that word. Now we're going to use it now more in our context. Regulators. This is the third piece of the puzzle that everybody overlooked or said, hey, the regulators will just have to follow because this is the new way. Technology leads it. And we obviously know now that's not going to be the
That's
case.
how it is.
So
That's right.
and that's where the confusion has been when you see all the benefits, you see the benefits of tokenization, how great it can be. You see the benefits to an investor from the clarity, for the transparency, immutability, and potential liquidity. And then the big question comes up, then where is the stumbling, where is the hiccup in all of this, in the market, the confusion, and where are the additional benefits? So let's talk a little bit further on the benefits. So we talked about the investor side. Let's talk a little bit more about the as an overall from the A to Z on the private capital markets. And I know for some, yeah, we're going to unveil it for you because I think most people don't realize that when a company chooses to raise capital, it one, the company needs to be a legal entity, number one. Number two, the likelihood that the company will have a lawyer is pretty high and an accountant or auditor. Number three, the company will have to file in order to raise this capital. So the United States in particular has great regulations for whether the company is 1 day old or 100 days old, for 10 years old, it doesn't matter, to follow certain regulations. You have certain regulations that say, if I use this regulation, I can sell my securities to anybody over the age of 18, and I have a limit on how much they can invest, and I have a limit on how much I can raise. So the rules are there. So
Yeah.
now you got the participants, you got the rules, and then the rules tell you who you can work with. You got a FINRA broker dealer, you need a bank for escrow, you need payment rail, you got IRA custodian. You see how the ecosystem just keeps growing and growing and growing. And here is the clarity in all this. That entire ecosystem is regulated. Each one of these lawyers are regulated by the Law Society. Auditors are regulated by their society. FINRA broker-dealers are regulated by FINRA. The issuer and the investors are regulated and broker-dealers by the SEC. IRA custodians, registered investment advisors or IRA, everything has rules and regulations to protect who? The investor.
And that's and that's the important point, Oscar. I think many people miss that. I'll give you a simple example: liquidity, right? They'll say, it's been like 5 years. Where's the liquidity? Well, you know what? They're comparing the public markets for liquidity. Those took more than 100 years to develop, right? It's been a very, very long haul for them, but to the time you can get here. So this whole question of protecting the investor, people misunderstand that. They think the regulations are there, they're very bureaucratic, they're very constraining. So, Oscar, we talk about this a lot, where we face some people come to us and say, oh, we are going to set up shop in, some other foreign, country, Gibraltar or someplace like that, because rules are lax, it's better for us. Well, you have to ask the question, if it's better for you, is it better for the investor? And sometimes it's not, right? So this all of these regulations are there for a purpose. Now, I grant you, and people make this argument, they'll say, well, there's too many regulations and it's very onerous. Agreed, onerous. But that's exactly what tokenization and the blockchain is set out to do, is to make following the rules less onerous, more efficient, more fluid in the markets, right? I mean, that's the whole, and at the same time, not losing the excellent benefits that you get from this wide diversification into various asset classes. So I think people need to understand this entire spectrum of the regulations that you mentioned. I mean, they're there for a reason.
Well, and that's just it. I mean, people keep asking there should be specific regulations for this. And the answer is the regulations are there. And that's the confusion. And that confusion has now, that clarity has been spilled out by the SEC over and over and over again. And this is, again, coming back to what I said earlier. The tokenization, not a problem. The SEC has no issue. You want to call it a digital security, you want to call it an NFT, a security token, whatever you want to call it. You can call it boo boo baba banana cherry, whatever you want to call it. Great. But here is the rule base. Now, the interesting thing is that if you have no experience in the private capital markets, and I think this is where the confusion also lies, is that most of the participants that have come out only see the high level. Come on, we've got to be able to help companies out. This thing's going to transform. Look how simple we can make it for an investor to invest in the company. Great. But did you do all the other things that are necessary in order to be able to do that? And so, initially it was for everyone. Then it was only accredited investors. And then, it went to institutions. Because what they ended up discovering is that the technology they created would not meet the requirements. So this is one of those situations. And if anybody's ever run a software company or been working for a company, do you try to push a technology into something like a square peg, or do you find the one that fits what is needed? And it's the latter. It's you get your specifications out. This is the rules you got to follow. And can it make it more efficient? The answer is yes. It's just that it's not that product. And for those who are old enough, you may recall way back in the 90s, there was a time, I kid you not, there was a time, not today, but there was a time when companies needed to make a very distinctive choice. I'm either going to use IBM DB2 or am I going to use Oracle? And it was not, they didn't talk to each other. It was a hard decision. They needed to make decisions based on speed, expandability, a whole bunch of different factors. And both companies grew. Both companies grew in their own specific verticals and so on. And then over time, they came for a way to bring it all together. And today we have more than, over a dozen types of databases. My point is, in blockchain, it's the same. There isn't going to be one that rules it all. Public is one way to, public is great. If it's going to be for public records, like for real estate and stuff like that, it may have some purpose. But overall, we're starting to see that when you take the rules that are there, and this is the confusion, you've got to start with a rule base. You've got to start with the process that is currently being done. And if it takes 100 steps, these are the 100 steps. I'm not saying applying 100 steps. I'm just saying that's how they do it today. Analyze it, understand it through and through, and then understand the rules that need to be applied to those steps. There's a reason there's 100 steps. People go, why are you doing that? Why do you need to collect that? Well, because I'm regulated and I'm required to collect this. This is the thing that a lot of the Web 3.0 people didn't understand, is that yes, you can build a marketplace and all that, and the individual owns their profile. Fantastic, great. But a FINRA broker-dealer, an SEC transfer agent, the bank, every one of them require that information in their silos to be provided. The individual does not own their data at that point. And I think this is the confusion point where we're not saying that technology isn't good. It just is not applicable to this environment. Now, one could say, how do we get there? The way to achieve that goal is eventually change the rules, but those things take decades. So for now, let's stick with what we have. So let's continue that journey. I mean, look, we discussed from the A to Z, and what is the A to Z inefficiencies for applying the regulatory framework. So let's talk a little bit about the, and I'm going to use it, and I hope everybody catches on to this word. It's called the private capital markets for a reason. It's been designed in such a way that investors want to remain private for their protection, which they can. And number two, companies want to keep their information private as much as they're depending on what regulation. But let's talk about now how the private market, where does it fit in within the tokenization and using what technology?
Definitely. I mean, so speaking from a technology perspective, right? So there are various types of blockchains out there. There's the public chains, and then there are the permission chains. One of the major points of confusion for most people coming newly, freshly to this space is, why can't we use just a very open public type of chain to conduct our transactions, tokenizations, especially for securities type of tokens? And the short answer is that, these, whether you call it tokens, digital securities, it doesn't matter what you call it, they are, and securities, and they behave like securities. And securities are not bearer instruments, right? So they are non-bearer instruments. So for that reason, there are a lot of protections built into them. So if I'm selling my shares to you, Oscar, I mean, it's a private company, I'm selling my shares to you. Why should a sheep farmer in Nairobi have anything to do with authenticating and validating our transaction? That person, good person probably, but they have no clue of any regulations, any laws, anything to prevent. They don't know KYC, ID, AML, nothing, right? So people who are not part of the transaction, who do not have a fiduciary responsibility, or they're not a regulated entity, should not have a say in validating transactions between two parties in this space. And for that reason, you now come back and look at the permission chain, for example. The permission chain is there for a reason. People who participate on the chain need to be regulated. They need to have a fiduciary responsibility. They need to be parties to the transaction. It just can't be a random Joe who is just running a node trying to validate your transactions when they do not understand the business process behind that. They don't know if the money came through. They don't know if the transaction adheres to certain regulations, to money movements, right? Money transmission laws, jurisdictions. They don't understand any of that, and you don't expect them to. So this is, I think, where people really get hung up. They think they can just use a public chain. They can do, all these wonderful things, but you can't, precisely because these things are not bearer instruments, and they're all subject to the securities regulations, right? And I think that's really a major point of confusion.
Correct. And I think to add to that, the part of the whole thesis of tokenization, coming back to the beginning, is
Mhm.
that it offers this amazing, immutable ownership. It was easy to, I have it, I can now trade it. So, and this is another component of private capital markets. The regulators have two different distinctions. Distinction number one is that there is the primary, that's when you initially invest in something. And then
Mhm.
there's the secondary, which is
Yeah.
now when you wish to sell it or you wish to buy. And a lot of people convolute these two particular transactions in the same, environment, and you can't. And so, number one, from a regulation point of view, not all regulations allow you to trade it. So that's number one. So it depends on which regulation you're going to use. So if you're going after accredited, you're using Rule 506C or 506B, then you've got further restrictions. And on top of that, you have another major limitation, and that is the company cannot exceed 2,000 shareholders. So, this has been our argument for a long time, which is tokenization is about fractionalization and making it available to everyone. But now you have a regulation like Reg D where, wait a minute, I'm going to tokenize it. Excellent. Spend $200,000. And now you could only have no more than 2,000 shareholders. Otherwise, you become a full reporting issuer and you'll be, getting listed. If you all read the story about Facebook, if you haven't, go look for it. This is one of the reasons why they went public for this rule. So that's Reg D. And that's just on the shareholder account. And then the additional restrictions, which is one of them is a mandatory 1-year hold. And further, there are tag-along rights, right of first refusal, whatever all the other show. And we're not done yet. One more, the investor on the other end also has to be an accredited investor to purchase it.
Yeah.
So
even if they're not accredited, depending on the regulation, at least KYC, ID, AML must be performed on them. Absolutely.
Well, that's the basic. In every one of the regulations, ID and AML is only 2 parts out of 3 or 4, depending on the regulation. So this is where people go, oh, we do KYC, it's fully compliant. Well, again, regulations. So if it's a Reg D, you have ID, AML, then you have suitability, and then you have investor verification. And this is the one, again, so the regulators have created so look, it may sound onerous in describing it, but can blockchain make it easier for the onboarding, and can it make it easier for managing? At the end, all of the answers is yes, yes, yes. But we cannot overlook the point that in order for tokenization to work and to be compliant, people need to follow the regulations and understand them. So you understand the regulation, you need to look at it from, here's the regulation, and you have 3 different ways to look at it: from an investor, from the company, and the intermediary. And why those 3? One, you need to understand the type of investor that you can attract. You need to understand how you can attract that investor, what legally you're allowed to do. So give you an example, in Reg D 506C, I can put up a billboard and say I'm raising, $100 million for accredited investors only, fully compliant. But if I use Reg D 506B, I'm not allowed to do any of that. Yep. I'm not allowed to solicit. I can only target people I know. Same rule, same, I'm raising the same amount of money. Second, then understanding from an investor where they can come from, who they are, they need to be accredited, and so on. Then you need to go from the company. What do I need? You're going to need to file a Reg D statement with the SEC after 15 days after you've closed. You are going to need a PPM, most likely, and audited financial statements. It's not mandatory, but it's very likely that you will. And then there's the intermediary. So who are the intermediary? The intermediary are the FINRA broker-dealers who can work with you, or investment banker, they're registered broker-dealers, who will represent your company to raise capital, and you pay them X. They'll have a responsibility to onboard you, due diligence, they'll go through bad actor checks and all that. And so all of that process doesn't go away, but the important thing is, can the value of all this is that if it's done correctly by regulated participants, there's a value in how that information can be shared among other partners. So I'm going to show you the value of tokenization just in the Reg D, the most stringent of all regulations. When you have a lawyer and auditor, you have a broker-dealer, a bank for escrow, a payment rail, and all that. What they all have in common is they all need to onboard this company. They all need to onboard it. But if they were on a blockchain technology that it was trusted amongst all the participants, the first regulated participant, and let's say it was the broker-dealer who conducted the due diligence, collected all the information, including bad actor. That information doesn't need to be duplicated by the company again. It could just be shared and instantaneously trusted by the other participants in order for the transaction to move more fluidly. So coming back to those steps A to Z, tokenization doesn't remove the steps, it just makes it go faster where we get the clutter in the private markets. If people understand really where the delay in private markets is, it's the sharing of data amongst all the participants you need. So that's why when people say tokenization is great, we can streamline it, we can get rid of all the intermediaries. And regulators are saying you can't get rid of anyone.
No, no, no. I mean, I think that's a common misperception, right? I mean, people think that, if you remove the intermediaries, things will get better, but the risk still stays. You cannot disintermediate the risk itself, right? I mean, that's the reason why it's important. But Oscar, you brought up a very interesting point. And I want to highlight this one because not everyone may have caught that, and you said it in a quick passing. So with tokenization and blockchain, the way the intermediaries work today in the traditional securities world, for example, is going to change quite a bit. It's going to change the way, it's going to affect the way they actually conduct their transactions. And one of the classic ones you just mentioned is, if the KYC has been performed on someone and it is current, there's no reason why that cannot be tapped into because it's now on the blockchain, it's immutable, verifiable, and it's no one can cut up that. So it's there. So now the workload and the workflow for an intermediary becomes so much cleaner and faster, right? I mean, everyone benefits from that, right? They don't have to redo this stuff all over again, right? So
Agreed. And that's just the primary. We just talked
just a
again. This is
primary,
where everybody
exactly.
convolutes. That's just the primary. And now you take that investor, right? After that broker dealer vetted you in, did all the homework, ID and AML and investor verification, and now you want to go out and sell it. Okay. And for those who have never experienced secondary market trading, we work with one of the earliest one you may recall way back, 6-7 years ago, and it was literally taking them months because what do they need to do first? They needed to contact the company with the phone. Hello, John. Yeah, just want to confirm. And then they would need to get a letter. They would need to get a letter, an opinion letter from the lawyer. Then they would need to confirm the ownership. Then they would need to review the legal agreements to make sure that this individual can and cannot sell. With blockchain, we don't need to do any of that. The secondary ATS now knows exactly what the rights are. Yes, this is Kiran's Garimella. He owns 1,000 tokens. He can sell them. It could only be a credit. It gives him all the things without going through the verification all over again, coming back to the smart contract. But again, there's the value. So did we take away any of the steps that were mandatory? The answer is no. Why? Because, the proper KYC was done at the beginning. Now he wants to sell it. There's a secondary ATS operated by a FINRA broker dealer or one with a license for it, and there's an SEC registered transfer agent to do the settlement of the transaction. And there is a gateway between for the fund for the payment of the security. So now what you've done is removed all the bottleneck and made it seamlessly. Unfortunately, I know for those who have been watching the market tokenization, you're going, well, Oscar, we've been seeing all this. What you're describing is not what happened. Agreed. We're 100% agreeing. We're having this discussion today. We're calling it tokenization for the private market. Confusion. The confusion has been people are tokenizing assets. People are tokenizing things and overlooking one critical issue in all of the process. Well, actually two. Number one, not understanding the entire process from A to Z and breaking it down from the primary to the secondary. And most importantly, overall, the regulation.
Exactly.
You know,
So you were mentioning, how this, how the modern technology of blockchain makes all this much more seamless. I'm reminded of an interesting thing that you told me. We were discussing this several years ago, and I came new to this private market space, and you said, Kiran, when you need to buy or sell a private equity, it's going to take you 3 weeks or something, just to, but you have to find a buyer. And the standard joke was you had to find a golf course and get a membership on a golf course, and on the 18th hole or 19th hole, that's kind of where you make your trade. You say, hey, do you want to buy my shares? And that's kind of how you do this stuff. But with blockchain, we get rid of the golf course and we can conduct business on the racquetball court, right? I mean, it's now much more democratized.
Well, we make it more efficient. We allow the ability to go there. So the question is now so the question when people are looking at tokenization, there are some really important questions you need to ask when you're engaging. So don't get caught up on the shiny light. The shiny light is tokenization. So we the value is there. We're not, I think so that's one. Number two, you're coming into the private capital market. So the purpose of tokenization is either to sell the tokens or the NFT, whatever it is you're selling, and you're going to sell it to investors. And we'll talk about that. And then where the confusion, there should be none, is that you now need to ask certain questions. And the question is, people say, are you compliant? That's not the question, because they all will swear up and down and say, yes, we're compliant. We do KYC. The real question is your tokenization compliant for that regulation? So in the United States today, there are 3 regulations that you need to be aware of. One is called Regulation CF, or Regulation Crowdfunding. This regulation allows a company to raise up to $5 million from anyone over the age of 18. They can raise $5 million every 12 months. You can tokenize this, you can do kosher, whatever it is. But if you're going to use that regulation, you need to follow it. The company needs to file, needs to audit funding. So if the company has all of that, the provider that they're working with must also adhere to the rules. So if the company did everything correctly, so does the technology provider. The technology provider must meet those requirements in order to keep the company compliant. This is a really important part. You did the filing compliantly, now you need to do the offering compliantly, because if not, you're going to be like every other one where you need to reverse that and refund everyone back. And if you're lucky, you won't get a fine, but most likely you will. And so you don't want that. So you need to ask this, is this compliant with Regulation CF? And compliant means, have you gone through the front door of the SEC and said, knock, 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 and had it qualify? So there are 2 terminologies that we're going to share with you today. So, Kiran, you want to do the no action letter or qualify? Which one suits you better?
I like the no action letter because that has a lot of interesting twists to that one.
All right, so I'll do qualified. So qualified, what does it mean? Qualified means that you've gone through the SEC, taken the regulation, you've asked for no special arrangement, you follow the rules, and you've demonstrated to them that we're using this regulation and we're going to use this blockchain technology in order to manage the process from A to Z with all the regular participants. Once you get that and you get qualified, you'll end up in Edgar. Your name will be in Edgar. Just like if you go there and you see KoreChain is on Edgar. It is a public record. It needs to be. And this means once it's qualified, this is the word qualified, not approved, qualified, that the next company can come in and copy, use the same company and go through it again and again and again. That's what qualified means. That's why it's a public record. You can rely on it. You can make a note to it. So in essence, nothing is stopping any other blockchain company to go through this process. There are other reasons, but if you do, there's a time frame. It took us only about 2.5 years to do it, but we did it, and there it is. We got ours in 2022, and here we are. We're the only one to date, and there'll be more. I am convinced there'll be more, but you need to follow. So now let's talk about the no action letter, that mystery word that they don't talk about a lot.
Actually, I just want to make one more point on the qualification. I think people need to really understand that a qualified offering simply means that all the rules were followed correctly and it's all compliant. The SEC does not comment on the business model or whether it's a good business or a bad business. It doesn't say that, right? It simply says, have all the rules been followed clearly and correctly. Okay. So coming to that no action letter. So Oscar, we have seen several instances in the past and I'm sure we'll see even more. People want to push the boundaries of what they can do with blockchain, with tokenization, and then they pose a question to the SEC. And of course, SEC, and they spend like, so I think we have seen cases where they spent like $2 million just going through the motions of trying to get a no action letter from the SEC. But at the end of the day, it really doesn't mean anything, right? It just simply say, I don't know what it actually says, and that's the mystery behind what is it actually buying you, and that's
What is a no action letter? So a no action letter, there's some examples of it. So what you're asking the regulators to do is approve this company to do these things and to allow them not to follow certain items. And so when companies, there was one company that made a big announcement that, hey, we just spent 1.5 million. Now we created a road path for everyone to follow. Well, that's where they made the mistake. So a no action letter is a one-time instance only. It's only for that company and nobody else can use it. What does that mean? Anybody else taking that company will have to go through the entire process all over again. You cannot rely. It's not a process in which the SEC is saying for this instance, for this company, this particular, and in most cases, the joke is we call it a no action letter with no action. What does that mean? You spend all that money and you could have already done it in your own way using this other regulation. I mean, my favorite one was the airplane. It was a tokenization of an airplane, and what they were offering is to tokenize the airplane. This company spent, I don't know, almost $1 million in legal fees to get this. And the joke was that after they got it, they go, hey, we can now tokenize the airplane. So one, the investor couldn't get a refund. They couldn't trade it. If they wanted to get a refund, it would be it would lose part of their investment. So it was all disclosed. In the end, it never raised anything. But when you compare, you go, okay, wait a minute. You blew almost $1 million in legal fees. You could have paid $75,000, gone through the Reg A process. You could have been able to go and raise money from any investor over the age of 18 and give them a free trading security where they can buy it and then trade it. And you could, and it would have been tokenized. So I do understand the value of public chains. This is not what we're saying today. Is tokenization in the private market is that it needs to be private. So the environment today, in order to be compliant, and I'm going to go through all the participants, lawyers, auditors, broker-dealers, bank, payment rails, IRA, RIA, and the list goes on and on of regulated participants. Each of them have rules they need to follow. Each of them have rules in how data needs to be, managed, given to them, and provided to their regulators. Today, the technology today, and it could change in the future, but today, the technology that meets that requirement is a private chain. There's another value as well. For those who have been investing before blockchain, you never had to pay for the movement of this to this from one person to the other. There was this gas fee element. So in private chain, all of that is removed. There are no more wallets. When was the last time you invested in a company and you're carrying it in your wallet everywhere you went so you could use it? You didn't. You made an investment so you could see it grow, and you watch it and you log into your computer or your mobile device, but you don't carry it in your wallet. An investment is that. It's an investment. So again, this is not targeting crypto assets or commodities. That's, hey, Bitcoin, all of that, great, love it. Can you use Bitcoin to invest into a private company? The answer is yes. It gets converted to fiat, so it's not a problem. But we need to make sure that people understand. So the confusion has been people are not asking the right questions. So we've gone through Reg CF, $5 million. And the company has to file with the SEC. There's a Form C that needs to be filed. And everybody that company is working with has to be fully compliant. Number two, Reg A. Reg A allows the company to raise up to $75 million. Once again, fully regulated, the company needs to file a Form 1A. and it needs to be qualified, and it has all these different participants to work with. And then there's the Reg D rule. The Reg D is the accredited investor rule. Do you need to follow everything? The answer is no. There's a lot of things you don't need to follow, and it is that, but you went from a population of 233 million Americans to like that. And most important, now I'm going to come back to a really interesting rule. Reg CF, you can have unlimited shareholders. So fractionalization will work. Regulation A+, you can have unlimited shareholders. Look at that, you can fractionalize. Reg D, you have a limitation of 2,000 shareholders. So now you've got another reason. You see, the more you understand the regulation, you start going, why didn't I know this before? And then the last piece, tradability, liquidity. So in Reg CF, there's a 1-year hold, but after that, it's a free trading security. Not bad. During the first year, people can transfer it to family and friends, but after a year, boom, no hold, way to go. Regulation A, you bought it on January the 17th, and if the broker dealer approved it and qualified it and you're on the cap table, boom, you can start selling it the same day. It's a free trading security the minute you receive it. And then there's the Reg D. Well, the Reg D, again, you'll probably have a shareholders agreement, you have other rights you need to follow, and you got Rule 144, where you have to get the legal opinion before all of that disappears over here. So here's the way that I've been positioning tokenization in the private markets. I'd like to hear your feedback on this, and that is, in whose best interest, and you said it at the beginning, in whose best interest are you doing when you're using a regulation? So when you use Reg D, it's in your best interest, because you don't have to do any you don't have to do any filings with the SEC prior to you raising your capital. In fact, you can raise your capital on a napkin. If people are willing to take it, boom. But in Reg CF and Reg A, there's a regulatory requirement that you need to file certain information with them prior to you going live with your offering. So there is oversight. There's other elements as well. So I believe tokenization is definitely going to skyrocket in 2024. And the confusion now should hopefully diminish when people start asking the right question of the shiny lights, which is, have you been qualified for Regulation CF?
Yeah.
Have you been qualified for regulation? If not, then I can only do Reg D and accredited investor. And then you got to ask yourself this one basic question: why tokenize if you can only have 2,000 shareholders? Your thoughts?
Yeah, I mean, definitely. I mean, so we know there's a lot of confusion in this space. And, sometimes I make the joke that, you're seeing this bright light coming at you. It's either the light at the end of the tunnel or it's a train rushing at you. So one is a disaster, the other is good. Okay. And what's the difference between the two? It's education. It's really learning about all this stuff, right? So Oscar, you and I, and many of our colleagues in this space, we know this space extremely well. We know all the pitfalls here and there, but education is the key. So in this last few minutes, I think we should share some best practices and how the different participants can educate themselves. Now, the issuers need to go through a certain level of education and learning on what this means. So do the other intermediaries, the broker dealers and ATS operators and so on. But for the investor, when an investor comes to these markets, I mean, think about an investor going to the public markets. There, they don't have to educate themselves on is a company good or the bad or etc., except from an investment standpoint. But in the private markets, they need to really understand, is this company being, is there a FINRA registered broker dealer behind it, right? So they need to know a lot more things to protect themselves clearly. So, we talked to a lot of investors, we talked to companies around this one. And we are in this education space. I mean, we want to educate people, because it benefits all of us, right? I mean, that's the key. This is a huge market, and 2024, 2025, we're going to see 100x, 1000x, 10,000x going forward. What's happening? And one of the reasons I say that, Oscar, and I would like your take on this one as well, is in the private markets, together globally, they contribute between 40 to 60% of the world's GDP. But
I know.
99.9% of all the noise, and you look at Wall Street journals and the Financial Times and Bloomberg and Matt Kramer and everybody else, Jim Cramer, all you're basically seeing is the public markets, right? Who hears about the private market? Nobody. And for that reason, I think it's amazing how much potential there is in this space. And to make this really worthwhile for everyone, education is really the key, right?
The education will be the key for at least, I like any new sector, new element to it for the next 5 years. And the reason for that is because we fundamentally made a mistake as an industry. You can't blame the regulators. The regulators just sat back and said, "Hey, this is immutable. This will be a great way to catch all the crooks." And they were right. I mean, they're
Yeah, that's
catching one
right.
by one. They're just not catching the real smart ones, but they all get caught because eventually, here's the interesting thing about tokenization: you need it in fiat because that's the only way you can pay your rent and your groceries and your cars
Right.
and your homes. So eventually, you got to come down from there and come down this path. So, as they say, be careful what you wish for. So tokenization is going to be very transformative in the private markets, but it requires people who understand how it works and have an appreciation for the back office. The everyday investor isn't going to see it right away. No different than if you anybody today who gets married and has a child, in 18 years from now, they'll go, "How did you get your driver's license again? That's so crazy. I just sat in front of the computer, took my picture, put my thumbprint in, and I got it." So,
Actually, my
it's
fear is they might actually say, driver's license, what is that? Because I have all self-driving cars in, right? It's
correct.
completely
We're carrying
transformed.
we're all these things that are inefficient: a
Yeah.
telephone, right? A video recorder, a cassette player, a disc. So tokenization is going to keep evolving, but companies and investors need to be asking the right question. Investors need to ask, is this compliant? You need to see it on the website.
Yeah.
The website should indicate who the FINRA broker dealer is. You can go to broker check to see if the broker dealer is real. This is how you can protect your investment. Yes, sometimes it's too good to be true because it is. And we've now seen that with, stable coins, everything has been a bust. So I don't know how much more people need to lose in order to get this, to make sure they understand. In the private markets, those who are going to survive and make it are those who have a respect for the regulators. And we're making that momentum. We're already adding blockchain in the space and making a difference. And it's going to take time in order to bring everyone on board. And once you do, the real value for the investor will be, wow, I bought that. That was so simple. I made my reinvestment by just entering this, and I went through it like, it used to take me 5 minutes to make an investment. Now I did it in 30 seconds. And then I was
Yeah.
able to trade it. And it was really simple. We don't have that. We're getting there. All the pieces are there. It just requires those participants who have been playing on the other side. And I get it. If you're a broker dealer, you're like, oh, maybe it's outside of this. But it's the rules. It's not about the shiny light. So the rules dictate how you operate, and the rules dictate how everyone needs to participate. And you cannot discount one or the other.
Oh,
You cannot,
absolutely.
right?
Yeah, no, absolutely. I have my favorite, tip to share for investors, and that is when you look at a tokenization offering out there, always ask what's behind the token. What does a token actually represent? Is it hot air crypto kitties, or is it actually producing farmland and real estate or something tangible value? And that is my tip for investors in this tokenization space.
Yeah, and that's a good one. For me, it's all about regulation. And then so that's from the investor. From a company perspective, when you're looking at participants, yeah, you gotta be asking these questions. The SEC has no
Absolutely.
mercy. We don't you don't get to see all the fines, but every single day, if you put your name on the alerts, you're gonna see every single day. And get this. So the SEC has an interesting list. It's called the bad actor list. So if you get put on the bad actor list, you will never be able to participate again. Why? Because the regulators in the regulations require the intermediaries. So listen carefully here. The intermediaries to run a bad actor check on the individuals, so officers and directors and major principals of the company. So you really have to understand that playing by the rules is the most profitable way and the most exciting way to be able to deliver everything end to end. And this is how we eliminate confusion in the market, by asking the right questions. And to ask the right questions, you need to be educated. And what things we cannot overlook is that you are investing, therefore it's regulated. So that's your starting point.
And ignorance of the regulation is not an excuse with the SEC. People have to remember that.
100%. There is none whatsoever in any way. So hopefully today, look, our goal really is, it's a topic that has been discussed in every webinar that I've attended. I don't know how many in the last little while. Tokenization is great for real estate. Tokenization is real for this. But here's the meat that they forget. And they talk about the real value of tokenization, where you can get your payments faster. You can, and here's the back of my mind. Who's going to say it? And I'm going to bring up one of my great advisors by the name of Mr. William Dima. And he was one of my advisors during when Enron collapsed, teaching me about corporate governance. And he used to say it's called the pink elephant in the room. The pink elephant in the room when people like this are speaking is, excuse me, what regulation are we going to use to accomplish what you're saying? And that's when the conversation ends. Oh, it doesn't matter that this is about tokenization real estate. You can do it anywhere in the world. For a company, you better start running. Run as fast as you can. Now, people, you said it earlier, you can go to Gibraltar, you can go to Switzerland, you can go, okay, great. You know what? If they allow you to do that in that jurisdiction, meaning that country, then go for it. We're not, if you want to do anything in the United States, the world's greatest private capital markets, which in 2023, $4.5 trillion, or sorry, 2022, $4.5 trillion was raised, then you got to play by the rules. And the rules are there. They're simple. They're not difficult. There's a lot of great companies out there that you can speak to, but you have to do it compliantly. And ultimately, always remember this, no matter whose advice you take, the only one that matters is the SECs or FINRA. Meaning, why? Because they're the ones that will come after you. You know, I remember one of the companies, I need to digress a little bit. There was during 2017 and 2018, when they were being targeted by the SEC, and the company said, well, my lawyers gave us a letter. No, unless the letter was written by the SEC and they said you could do it, you do not rely on that. So educate yourself. There's enough information out there. And hopefully today, you know, we've kind of given you a spotlight. This information will be available online. We also have some papers that you can learn about what the private capital markets are. And for anybody who is starting to build a company in this space, go for it. There's, oh my God, you're right. There's trillion dollars worth of assets ready to be tokenized. But keep in mind that you need to come in the door with the terminology that audience is now ready. And the bigger the company is, I guarantee you that's the only thing they're going to be caring about. Are you compliant? You know, and these are what regulations do you support? Who are the participants that can collaborate? That you have FINRA broker dealer, do you have secondary ATS, do you have an SEC transfer agent, do you have a bank, do you have IRA, do you have RIA, you know, and the list goes on and on. That is an ecosystem of compliance in the private capital markets. Your last words, Kiran.
Absolutely. I mean, you know, people hearing all of this stuff, you know, there is continual confusion and requires a lot more investigation. But the one big key takeaway is that tokenization is extremely transformative, and sometimes not for the reasons you think it is. But if you kind of open up your mind to this one and keep regulation, compliance, safety, and security as your cornerstones in your thinking, I think you'll be safe. But it is going to be a tremendously fantastic ride.
Agreed. And thank you again. And I hope it was, informative. I mean, for us, it's just sharing what we share with people on calls. We get asked these questions, and I'll leave all of you with this. Why is 2024 such a great year for tokenization? Because we put an end to the FTX and Binance fiasco, as you heard from us last week. That clarity now, that whole chaos, that confusion, it shouldn't be there anymore. FTX and Binance, it's a stark reminder to everybody. Regulators are saying you need to be compliant, and that is trickling down all the way here. So until our next KoreSummit webinar on blockchain, we will see you next Wednesday. Again, I sincerely apologize to everyone for the mix-up on the platforms, but we are coming back to this platform where hopefully you'll enjoy our interactiveness in our engagement. And until then, have a fantastic week. Enjoy it, and hopefully it was enjoyable. See you next time.